Gold isn't having a good week. It is rewriting the rules in real time, and a lot of people who get paid to sound calm are trying to wave it off like it is nothing. This move isn't emotion, it's math. And the part that matters isn't even the headline spot price you see on your phone. It's what the market is being forced to do underneath the surface, where paper promises collide with delivery, collateral, and spreads that don't lie. Because if gold can push through record territory while the world is still telling you rates are high and the dollar is strong, well, then the message isn't buy gold. The message is the global system is quietly repricing trust. And later in this video, I am going to give you the exact tells to watch over the next week or two. The levels that matter, what confirms the thesis, what breaks it, and the one hidden metric that will make this whole move click for you. Start with the obvious, but don't stop there. This month, gold didn't just drift higher. It made a statement above the kind of levels that usually trigger profit-taking media hot takes and the classic bubble word. We saw a surge that took price up through the mid-4,000s per ounce, tagged fresh highs, and then, this is important, we didn't get the clean gravity that people expect when a market is just frothy. Instead, we got that weird kind of strength where dips get absorbed quickly and the selling feels reluctant. And that's where the real pressure starts. Because when a market is truly overheated, sellers can't wait to hit it. When a market is structurally tight, sellers hesitate, liquidity thins, and even small buy orders start moving the tape. Now, I'm not here to pretend the market only goes one direction. It won't. Gold can whip around violently even if the bigger signal is correct. In fact, when the signal is correct, volatility is often the weapon used to shake people out. But the reason this matters to macro watchers, metals people, and anyone skeptical of the official story is simple. Gold is one of the few assets that trades like a referendum on the system itself. Not because it's mystical, because it sits at the crossroads of currency, collateral, and confidence. And right now, the market is acting like confidence is getting more expensive. But that's not the part that matters. The part that matters is the gap between what people say gold should do and what gold is actually doing. The tidy script goes like this. If the dollar is firm and real, yields are up, gold should struggle. If equities are holding up, gold should calm down. If inflation is contained, gold shouldn't be screaming. And yet, gold has been pushing like something is pulling it. Not chasing a story, but responding to a constraint. That's the first clue you're dealing with structure, not sentiment. So let's zoom out and frame the message to global markets. When gold behaves like this, it isn't a localized trade. It's not just an American story. It is a global pricing signal because gold is the neutral asset in a world of competing liabilities. If you hold a currency, you hold somebody else's promise. If you hold a bond, you hold somebody else's repayment schedule. If you hold gold, you hold an asset with no counterparty risk. And in a world that is increasingly allergic to counterparty risk, that matters. But here is the twist. The bullish gold story you hear in mainstream commentary is usually a simple story about fear. Investors are scared. That's the lazy version. The real version is about collateral preference and the cost of certainty. And that's where the second clue lives. Because the mainstream is staring at the chart, the real tell is the plumbing, the parts most people never track. Future structure, spreads, carry. The cost to turn paper exposure into metal exposure on a timeline. The quiet premium people are willing to pay for immediacy. That's the hidden detail we're going to unpack. And when you see it, you're going to stop thinking of gold as a trade and start thinking of it as a pressure gauge. And if this one pressure gauge is rising while other gauges say all good, it means one of the gauges is lying. Let's talk about the force trying to deny this move, because understanding that force is how you keep your head when the volatility hits. The denial force is a mix of narrative inertia and positioning. Narrative inertia says, we already know the playbook, rates up, gold down. Hosta. Positioning says, if gold keeps rising, someone is wrong, and someone will be forced to act. And forced action is the engine of big moves. But that's not the part that matters. The part that matters is what gold strength forces other participants to do this week, not what it means philosophically. When gold rips and holds above major psychological levels, it changes hedging behavior. It changes how dealers manage their books. It changes how corporate treasuries think about reserve buffers. It changes how funds with mandates rebalance. It changes how short sellers sleep. And that cascade shows up first in market structure. So here's the clean model in plain language. There's paper gold, and there's gold you can take delivery of. Paper gold includes futures contracts, unallocated accounts, and various synthetic exposures that give you price movement without you ever touching metal. Physical gold is the metal, bars, coins, deliverable units, and it lives in a supply chain with refining, transport, vaulting, and constraints that don't care about your narrative. Most retail investors watch the paper price and assume it's the boss. But paper price is a negotiation between leverage and confidence. Physical availability is the constraint that can veto that negotiation. Futures markets are designed to let people hedge and speculate efficiently. Great. But they also create a situation where a lot of gold exposure exists as claims. And claims are fine until the market cares about delivery timing. Delivery timing is where behavior changes. If everyone is happy to roll contracts forward, paper can dominate. If participants start caring about getting metal now or reducing reliance on counterparties, the curve and the spreads start to speak loudly. And that's where the real pressure starts. Now let S bring in term structure, contango, and backwardation without turning this into a textbook. In a normal calm gold market, you expect contango, futures prices slightly higher than spot, because holding and financing the metal has costs. Think storage, insurance, financing, all that. The curve is basically the market saying time costs money. When that curve flattens unexpectedly, or when near-term contracts get bid aggressively relative to later ones, it's the market saying time just got expensive, or more bluntly, immediate certainty is being priced higher than usual. That's not a vibe, that's a mechanism. And when you see gold strength alongside signals that immediacy is being valued, you have to consider that the rally is being supported by something sturdier than speculative excitement. You're looking at a market that may be experiencing paper versus physical tension. Not in some cartoonish conspiracy way, but in the very real way that supply chains and balance sheets work. Incentives, risk management, funding, delivery preference. That's what moves the real world. But that's not the part that matters yet. Because the first proof point you need is whether this is conviction or compulsion. And for that, you watch participation and positioning pressure. When a move happens on thin participation, it can be fragile. When a move happens while volume and open interest dynamics suggest fresh risk being added or shorts being squeezed, it can be self-reinforcing. The gold market has plenty of sophisticated players who don't chase headlines. They respond to risk. If a rally forces them to hedge differently, they become buyers, not because they love gold, but because their models tell them they have to. Enforced buying is the kind of buying that doesn't care if you think the price is high. Now layer in proof, point 2. Inventory and deliverability, the inventory illusion. People hear, there's plenty of gold above ground, and assume supply can always respond. That ass-like saying there's plenty of water on earth, so a city can run out of drinking water. Wrong category. The question is not how much exists, it's how much is available in the right form, in the right place, at the right time, and willing to be sold. Deliverable inventory is its own thing. Non-deliverable holdings are their own thing. And when markets get stressed, the line between available and exists becomes a canyon. Here's why that matters to price discovery. If deliverable supply feels tight on the margin, participants who need certainty will pay up to secure it. That doesn't always show up as a huge spot jump immediately. Sometimes it shows up as the curve behaving oddly. Sometimes it shows up as premiums in certain channels. Sometimes it shows up as a reluctance to lease or lend. Sometimes it shows up as sudden bursts of buying into specific delivery windows. It's subtle, and that's why it's the hidden detail. Because the mainstream doesn't track subtle. But that's not the part that matters. The part that matters is how global arbitrage turns subtle signals into violent moves. Proof point 3, the global arbitrage magnet. Gold is global, but pricing isn't perfectly uniform in every region at every moment. When demand is stronger in one hub, premiums can emerge. When premiums emerge, arbitrage tries to pull metal toward the premium. That means shipments, refining schedules, and vault flows start to matter. And here's the kicker. Arbitrage doesn't just balance price gently. If the tight region keeps bidding, it can yank the global price toward that tightness, especially when liquidity is thinner than people assume. This is one reason gold can move like a currency stress indicator even when your local headlines feel quiet. Now, proof point 4, institutional behavior that got loud. The stealth buyer in this market isn't the guy buying a few coins on a weekend. It is the institutions that can afford to be naive about currency risk and settlement risk. Central banks have been notable participants in the gold market in recent years, and that matters because they don't buy for a quick flip. They buy to reposition reserves, to diversify away from dependence on any single issuer, and to reduce vulnerability to geopolitical and financial pressure. When that bid is present, it changes the character of dips. Dips stop looking like opportunities to short and start looking like opportunities to accumulate. And that's where the real pressure starts. Proof point 5, the macro crosschecks. Gold doesn't need a crashing dollar to rise. Gold doesn't need yields to collapse to rise. Gold needs credibility to wobble. If the market starts believing that the official path, inflation tamed, policy perfect, system stable, is more fragile than advertised, gold can rise even with firm yields. Because gold isn't just reacting to the level of rates. It's reacting to the market's belief in what those rates will accomplish and at what cost. Think about it like this. If rates are high, but debt dynamics are worse if growth looks okay, but liquidity conditions are tightening. If inflation prints look fine, but the market suspects policy will eventually choose stability over purity, then gold has room to rise. It's not about the spreadsheet. It's about the political economy behind the spreadsheet. And yes, that makes some people uncomfortable, because it's easier to pretend markets are clean, linear machines. They're not. They're adaptive systems with constraints, incentives, and reflexivity. And gold is one of the few assets that telegraphs when the system is adapting in ways the press release won't say out loud. Now we hit the calendar trigger, the why now, that everyone ignores until it's too late. Markets don't just move because something happened. Well, they move because timing forces action. Options, cycles. Delivery windows, month-end and quarter-end positioning, thin liquidity periods, policy deadlines. These are the moments when a slow pressure becomes a visible move because participants can't procrastinate. They have to roll. They have to rebalance. They have to hedge. They have to post margin. And when gold is already elevated and volatile, those calendar moments can create reflexive feedback. Price moves force hedging. Hedging forces buying moves price. And suddenly, you're just staring at a market that looks irrational, but it is actually mechanical. This is where I want you to lock in the hidden detail fully, because it reframes everything. When the market quietly pays up for certainty of delivery, paper price stops being the boss. The spreads start being the boss. The curve starts being the boss. The cost of carrying exposure becomes the boss. And if you want to understand the message to global markets, it's not gold is up. It's certainty is up. That's a much more serious message. So what does that force participants to do right now? First, it forces dealers and desks to manage risk differently. If the market is trending and volatility is elevated, options positioning matters. You don't need a full-blown gamma squeeze story for reflexivity to show up. If a lot of call options are open around key strikes and price pushes into them, dealers who sold those calls may need to hedge by buying futures as price rises, which can amplify the move. If price reverses, that hedging can unwind fast, which is why you get those sudden flushes that feel like the world is ending for 12 minutes. That's the trap. But that's not the part that matters. The part that matters is that these mechanics create the environment where the crowd gets emotionally manipulated, and you're going to be targeted, not personally, structurally. The market's job is to transfer risk from impatient hands to patient hands. Volatility is the tool. A sudden dip after a big rally is designed to make you feel stupid for not selling the top. A sudden spike after you hesitated is designed to make you feel panicked and chase. Both emotions push you into the worst decisions at the worst times. So here's your psychology shield. Separate signal from noise. Signal is trend structure and market behavior around key levels. Noise is intraday chaos, headline whiplash, and the social media chorus screaming certainty. If gold is in a structurally strong phase, the market will try to convince you it's over right before it continues. And then it will try to convince you it will continue right before it pulls back. You don't fight that by predicting every wiggle. You fight it by predefining what would confirm the thesis and what would invalidate it, and then you let price do the talking. So let's put the two scenario lens on this. Scenario one is the controlled pullback and retest. Gold cools off, pulls back toward a prior breakout zone, maybe tests a round number level, and you see whether buyers show up with conviction. In this scenario, the market shakes out weak longs and resets funding and positioning. It feels boring and frustrating. It also tends to be healthier if the move is going to persist. The tell here is behavior. Do dips get bought quickly? Do we see repeated defenses of key levels? Does the curve stay firm? Does the dollar rip without crushing gold? If those things happen, strength is intact. Scenario two is the continuation squeeze with gap risk. Gold stays elevated, liquidity thins, and you get these stair-step pushes higher where pullbacks are shallow and short-lived. This is the scenario where shorts start feeling pain and forced buying can accelerate. It is also the scenario where you can wake up to a gap move and feel like you missed a lifetime opportunity, which is exactly when you make a terrible decision. In this scenario, the tell is speed and structure. Momentum stays hot, key breakouts hold without much retest, and dips fail to follow through. But the risk here is brutal. The same mechanical buying that pushes it up can unwind violently on a trigger, and that's where the real pressure starts. Now, I'm going to be concrete without pretending I know the future. The market will give you levels that matter, not because they're magical, but because that's where behavior changes. You're looking at three zones. The fresh breakout region that sparked the recent leg, the immediate support region, where buyers must defend to keep the trend clean, and the overhead area where the market will test how much pain it can inflict on skeptics. In plain terms, if gold can hold above the recent breakout neighborhood, the area that used to cap rallies, and now acts like a floor, that is a strong confirmation signal. If it loses that area and starts closing below it with momentum, that's your first warning. The move is transitioning from trend to mean reversion. And if it breaks deeper support, the thesis of structural strength right now weakens sharply, even if the longer-term gold story still exists. This is how you stay finance literate instead of faith-based. You define what breaks your view, and you respect it. On the upside, the confirmation isn't, it goes up. The confirmation is, it goes up and holds. It's, it goes up, and the pullbacks don't cascade. It's, it goes up and related signals don't contradict it. Watch the dollar, watch real yields, watch risk assets. Not because gold has to move opposite them, but because divergence tells you what's being repriced. If gold is strong, while the dollar is also firm, that's a different message than gold rising because the dollar is collapsing. The first message is more structural, the second is more obvious, and it's the structural message that sneaks up on people. Now, let's translate all of this into what to watch next, because that's the payoff. Over the next week or two, the market will give you a checklist. First, watch the curve. You don't need to stare at complicated screens all day. Just ask, is near-term demand staying sticky? Are the front months behaving tighter than usual? Is the curve flattening when it should steepen? Those are signs that immediacy is being priced. Second, watch for signs of stress in spreads and related metals. Silver, platinum, and even industrial metals can act like a chorus behind gold. If gold is strong and the rest of the complex is also firm, that can signal broader commodity reflation or currency hedging behavior. If gold is strong, but the rest is weak, it can signal safe haven preference and stress hedging. Different messages, different implications. Third, watch institutional flow proxies. ETFs and ETPs are not the only institutional channel, but they're visible. If you see evidence of renewed interest there while price is elevated, that suggests the move is not just short-term panic. If you see outflows while price holds, that can suggest the bid is coming from elsewhere, which is often more interesting. But that's not the part that matters yet. The part that matters is number 4. Watch how the market reacts to bad news for gold headlines. If you get strong economic data, a hawkish tone, or a dollar pop, and gold refuses to die, that's a loud signal. Markets that can't go down on bearish news are telling you buyers are deeper than narratives. And finally, watch the calendar. If you're heading into a period where liquidity thins, where month-end flows matter, or where options and delivery dynamics create forced decisions, expect amplified moves. Don't interpret every spike as truth and every dip as betrayal. Interpret them as the market's method for rebalancing risk under pressure. Now let's address the skeptics, because skepticism is healthy. It's what keeps you from becoming a hostage to a story. The counterpoint is real. Gold could be overextended. There could be profit taking. There could be a short-term turning point. Strong moves invite mean reversion. That's normal. Also, sometimes gold rallies for reasons that fade, and the unwind can be fast. This is why you don't marry a price. You marry a process. So here's the process. Condensed, you're not trying to predict the next dollar move. You are trying to identify whether gold's strength is being supported by structural signals, spreads, curve behavior, institutional preference for certainty, and then align your expectations accordingly. If those signals stay firm, the message to global markets remains, the cost of trust is rising. If those signals fade and price starts losing key support behavior, the message may shift to, the market got ahead of itself and is resetting. Both can happen without the world ending. Both can happen without your ego needing to be involved. And that's where you win. Let me say something blunt about volatility, because this is where most people get played. If gold is in a structurally bullish phase, you are going to see moves that feel designed to hurt you, because they are designed to transfer risk. You'll see fast drops that trigger stop orders. You'll see recoveries that make you feel foolish. You'll see overnight action that makes you feel like you can't keep up. That doesn't mean the thesis is wrong. It means the battlefield is real. So your psychology shield is this. Decide what you care about. Are you a macro watcher trying to read the message? Then your job is to watch divergence and structure, not chase candles. Are you a metals person tracking physical versus paper tension? Then your job is to watch the curve and the cost of immediacy, not get hypnotized by a 1-hour chart. Are you a retail investor who wants exposure without emotional self-sabotage? Then your job is to reduce decision frequency and increase rule clarity. Trend signal versus noise. 2 scenarios. Confirmation versus invalidation. That's how you stay sane. Now, what is the message gold is sending right now in one sentence? It is that the market is pricing the value of neutrality and certainty higher than it did before, and it's doing it through mechanisms that don't need your permission. That message leaks into everything: currencies, bonds, equities, even policy. Because if gold is strong in a world that's supposed to be stable, then stability is being repriced, quietly, but relentlessly. And here's the identity level takeaway, the subtle CTA without begging. If you are the kind of person who wants to understand markets through mechanisms instead of mood swings, stay in that lane. Build your checklist, track the structure, compare the story to the plumbing, and when you hear a confident headline, ask what the curve is doing. When you see a dramatic candle, ask who is forced to hedge. When you feel panic, ask what level would actually invalidate the setup. That mindset is the edge, and the more people around you who think that way, the harder it is for narratives to steamroll reality. So, for the next week or two, here's the clean map in your head. Now watch whether gold holds its breakout behavior on pullbacks. Watch whether bearish macro inputs fail to crush it. Watch the curve for signs that immediacy is still being priced. Expect volatility, because volatility is the tax you pay for being early, and the test you pass to avoid being late. And remember, even if the thesis is right, price can still whip around hard. That's not a contradiction. That's the market doing its job. Gold's strength sends a message to global markets, and the message is not gentle. It's telling you where trust is going, what collateral is preferred, and how fast the system is willing to reprice certainty when the calendar forces decisions. If one key support zone holds, the next leg can stay alive. If it breaks cleanly and the structure softens, you step back and let the market reset. No drama, no worship, just process. Because in the end, the people who win in markets aren't the ones with the loudest conviction. They're the ones with the clearest framework when everyone else is being emotionally yanked around by the same candle. And if you watch the hidden detail, the structure under the price, you'll understand the message before it hits the headlines.